Very good afternoon, everyone. Is audio video all clear? Let me know quickly. Audio video all clear? All right. All right. So we will be covering the union budget for 24-25 as fast as possible. So I'm getting these requests. We will try to complete it as fast as possible in best possible manner, right? So today, starting with this thing, starting with the static portion first. So I'll try and explain you whatever the structure of the budget is and just a glimpse of the history, because these factual questions can be important for your exam, right? So we will try and understand these facts. These are just facts. Then we'll try and understand the structure. What are the receipts, capital, revenue? What are the expenditure? What do we classify? How do we differentiate between revenue, capital, expenditure, revenue, capital, receipts, all these things, right? Then after that, once we discuss them at once, we will not repeat those concepts in the further analysis, right? So please be focused on the static portion discussion as well, because I'm not gonna repeat these concepts again and again to avoid repetition and to save time, right? Then after that, you will be able to understand what do we mean when we say that revenue budget is this, revenue receipts are this much, capital receipts are that much, right? So after that, you have all the deficits as well. So just a brief discussion of the static concept, what the structure of the budget is, then followed by the provisions which are laid down by the union government in this budget. Clear? Okay. Don't worry, we will try to complete as fast as possible. Okay. So this is just a brief history of budget, just a brief history of budget. You should remember these points. These are very important facts. So if you see, if we talk about India's first budget, when it was presented, so remember this date, India's first budget, it was presented on 7th April 1860, 7th April 1860, when India was still under the British colonial rule. So it was introduced by then Finance Minister James Wilson, right? So remember this thing, 7th April 1860 by James Wilson. Then if you talk about independent India's first budget, it was presented on November 26, 1947 by then Finance Minister R.K. Shanmukham Shetty. Okay, so remember this fact, independent India's first budget presented on November 26, 1947. Clear? Then former Prime Minister Morarji Desai holds the record of presenting the most number of budgets. So if there is a question that who has presented the most number of budgets in India's history, that the answer would be former Prime Minister Morarji Desai. Okay, he had presented around 10 budgets. Then this record is followed by your, so between 62 to 69, followed by P. Chidambaram, 9 budgets in his tenure. Then Pranab Mukherjee, 8 budgets, and then Nirmala Sitharaman, present Finance Minister, 7 budgets. So this figure is important. So presently, Honorable Finance Minister Nirmala Sitharaman has presented 7 budgets in total, right? This is just a figure, you should remember that. Now, if we talk about the further information here, budget 1919, so the budget presented for 1919 to 2000 by Finance Minister Yashwant Sinha presented this budget at 11 AM for the first time in India. Before it, that was being presented at 5 PM. So remember this thing as well. When first time the budget was presented at 11 AM 1919-2000 by Finance Minister Yashwant Sinha. Otherwise, it was presented at 5 PM. Now, this is something very, very important for you. You should remember when was the railway budget. So, the combined railway and the union budget was presented for the first time. This was in 2017-18. You should remember this. Okay. So, 2017-18 was the first time when the budget was started to be presented on 1st February, and the railway budget was merged under this. Railway budget was merged under this, and then from then it started to be presented on the 1st of February. Now here comes an important question. Can you name the committee? Can you name the committee which gave the recommendation for the merger of the railway and the union budget? Anyone? So it is Bibek-Debroy committee. It is Bibek-Debroy committee. Remember this name, okay? Bibek-Debroy committee. So Bibek-Debroy, one of the prominent members of Niti Aayog. So Bibek-Debroy committee had suggested, gave recommendation for merging these railway budgets and the union budget. Bibek-Debroy committee. Earlier, what was the practice? So in 1924 it goes back. Remember another name here. So I hope you have noted down Bibek-Debroy committee, right? So if I ask you, when was it separated? Because it was separated, then only we are required to combine it, right? So when was it separated? On the recommendation of which committee? So this railway budget and union budget were separated on the recommendation of Eckworth committee. On the recommendation of Eckworth committee in 1924. Eckworth committee in 1924. So remember these two committees, these are important related to your budget. Is this clear to everyone? Okay. Now, so moving ahead. This was just a brief history of the budget. No more details are required. This much is more than enough. You just remember these facts. Now, who releases this? You should be very clear about that thing as well. Who releases the budget? So you have budget division. You have budget division under the Department of Economic Affairs, Ministry of Finance. Budget division, Department of Economic Affairs, Ministry of Finance. This was just a few information related to budget, including the history and all. Now coming to the budget classification. So you need to understand why do we classify them into capital and revenue budget. So we will first try and understand the static or the structure of the budget. After that, understanding and quickly revising and mugging up the data would be easier for you, right? So coming to budget classification. Is there any constitutional provision which requires the government to classify the budget into revenue budget and capital budget? Yes. Okay. Yes. So you have Article 112 of Indian Constitution. You have, yes, Article 112 of Indian Constitution. This article specifies that the budget must be distinguished, on revenue account and on capital account. So this revenue budget and capital budget, we have two broad categories for budget. This is as per Article 112 of Indian Constitution. Therefore, the budget comprises of revenue budget as well as the capital budget. Clear? Now, under this revenue, so basically what budget is, if I ask you what budget is, so budget is a document of your estimated, say, expenditure and receipts. So we all prepare budget for ourselves, right? That's how the government also prepares it. So we try to estimate that, okay, for this, say, upcoming 1 month, on individual basis I am saying, say upcoming 1 month, this will be the sources of income for us and these will be our expenditures broadly. So this is how we prepare budget, right? Expected, estimated sources of earnings and then expenditures. So basically budget comprises of what? Expenditure and receipts. Expenditure and receipts. Right? Now, since we have classified budget into two broad categories of revenue account and capital account, so revenue and capital, both these accounts will have both expenditure and receipts, expenditure and receipts. Clear? Right? So, budget, if we talk about, see, this will be your classification. Okay? So, budget has revenue budget and then your capital budget. Remember this thing. You will have figures related to revenue budget. We will discuss the figures as well, right? So once we try and understand the static portion, then quickly doing the figures which have been presented by the government becomes easier. So you have revenue budget and then you have capital budget. Okay. Under revenue, you have revenue receipts. So revenue budget mein you have revenue receipts and revenue expenditure. And under capital budget, you have capital receipts and capital expenditure. So remember, in both the revenue and capital account, you will have both expenditure and receipts, expenditure and receipts. Clear? Now, revenue receipts and revenue expenditure, capital receipts and capital expenditure. Revenue receipts are further classified into tax revenue and non-tax revenue. Main budget analysis, or when we try to understand the budgetary components, structure of the budget, it is this differentiation. How do you differentiate between each component? So what constitutes revenue receipt? What constitutes capital receipt? How do you distinguish between what is a revenue receipt and what is a capital receipt for the government? Right? Yes. So the primary parameter on which we try to distinguish between all these classifications of revenue receipts, capital receipts, budget, capital expenditure, all these budgetary classifications, is the status of asset and liability. Is the status of asset and liability. I hope this much is clear to all of you, right? So let me make you understand how do you classify between them. Once you understand the parameter on which we are distinguishing between them, whatever instrument is given, say, in front of you, whatever receipt, whatever expenditure is given in front of you, it will be easy for you to classify that, okay, this goes to the revenue account, this goes to the capital account. So you should try and understand how do we classify it. So how do we do that? It is on the basis of asset and liability status. Asset and liability status. Any receipts of the government, right, are they creating any liability for the government, or are they reducing the assets of the government? Getting my point? So these two questions only, asset and liability, will answer which of the receipts, which of the expenditure will be classified under which head. This is the thing, right? So this is how we are gonna define what are revenue, capital, receipts and expenditures. So first thing in the series, I hope this much is clear to you till now. So first in the series is your revenue receipts. Revenue receipts, right? So you understand what are receipts, whatever the government earns, right? And expenditure is your spending. Revenue receipts, essentially the definition then would be that all the receipts of the government which neither create a liability nor reduces the assets of the government. Neither create liability nor reduces the asset. So neither create liability nor reduces the asset. It means in revenue receipts, there is no change in the asset liability condition of the government. And this asset can be a physical asset and can be a financial asset as well. Right? So remember this thing, revenue receipts neither create liability nor reduces asset. Just remember this thing. Now whatever is in front of you, you can easily classify that, okay, this is revenue receipt. Try and understand why do we say that. Okay, so when we are saying that they are neither creating liability nor reducing asset, you know very well what is a liability and what is an asset, right? Also, if you get confused, sometimes the asset liability condition, as we mentioned in the balance sheet, has also to be referred. Okay, so say tax receipts, government receives the tax receipts, direct taxes, indirect taxes, so government earns from the taxes. Those will be revenue receipts, isn't it? So when you pay to the government via taxes, government earns the tax receipts. These tax receipts, they are neither creating any liability for the government, they are not reducing any asset of the government, for example. So this is how you define that, okay, this thing is going to come in the revenue receipts of the government. Is this clear to everyone? Right? So then we have the example, revenue receipts are also, remember this thing, the revenue receipts of the government of India are not to be reclaimed. So they are redeemable, non-redeemable basically. You cannot redeem them, right? You cannot reclaim them. So basically these are non-redeemable, non-redeemable. They cannot be reclaimed from the government. Government is not required to refund them. Are you getting my point? So revenue receipts, they can be further classified into two categories. I hope you have understood. So remember this thing as well, they are non-redeemable. You cannot reclaim them. Once the government receives these kind of receipts. So revenue receipts, the concept is clear. Now we classify revenue receipts into two categories. We classify them into two categories. These can be from taxes, so tax revenue and non-tax revenue receipts. Tax revenue and non-tax revenue receipts. All your tax revenue receipts will be where the government is earning these revenue receipts from the taxes basically, right? Now taxes can be classified further into direct and indirect, okay? You know what all are the direct taxes and what all are the indirect taxes. So whatever taxes, from all taxes the government is generating comes under the tax revenue. So direct and indirect taxes of the central government. Then you have non-tax receipts. What are non-tax revenue receipts? So under revenue receipts, apart from taxes as well, you have sources from which government earns. Yes. So say fees, right? We say government provides us a number of services, right? So we pay fees for availing a particular service. So any fees, okay. Now non-tax revenue consists of interest receipts also. Interest receipts on account of loans given by the central government. Loans given by the central government. Remember this thing. This is also non-tax revenue receipt. But one question is there which I want to ask you. Interest receipts on account of loans given by the central government. Government has given, say, any loan to someone and that then receives interest on that loan. Why is it revenue receipt? Because it is neither creating any liability for the government nor reducing any asset of the government, right? Okay. So whatever you earn on the interest payments as well comes under the non-tax revenue receipts. Then you have dividend, profit on investment made by the central government. Say any dividends provided by the PSUs, public sector undertakings. So dividends, what are dividends? Dividends are the shared profit basically. Dividend is the shared profit. What profit is shared among the stakeholders is the dividend. So dividends and profits on the investments. Then fees, as I told you, fines, if government levies the fines, right? So challan and all these income earned out of these sources are classified as non-tax revenue receipts, or any other kind of receipts can be there. Have you understood this thing? This is clear to everyone? Non-tax revenue receipts, right? So remember these heads. Remember these heads. Now moving further, cash, grants in aid from foreign countries and international organizations are also part of non-tax revenue. This was something we were referring to in general practice, from which all sources the government earns. But there are certain help in form of cash or any grants in aid, sometimes provided by any foreign country or any international institution or organization, that would also come. Now this is not loan, remember, it is grant in aid. Grants are different from loans. Remember this thing, it is not loan. Loan will be a revenue receipt or a capital receipt. Tell me, because loan creates liability. Loan creates liability. Loan cannot be a revenue receipt. By definition, revenue receipt is what? No change on the liability and the asset condition, right? Neither create liability nor reduces asset. So loan cannot be, but these are grants. Grants are not loan. Grants are unconditional, like donations, right? So these are grants, not loans. So do not confuse them with the loans. This is something related to your revenue receipts. Now moving further. So broadly, if you see, revenue receipts will have two categories, tax revenue and non-tax revenue, right? In tax revenue, you have all direct and indirect taxes. If you see the gross tax revenue which the government receives, now these terminologies are going to come in the budget estimates, right? Budget at a glance we will discuss. So these terminologies will be there. Now we are saying what is gross tax revenue first of all. Also, I request you all, you will get the PDF, so you can go through the PDF quickly, remember all these things. But for the concepts, if you find them difficult to understand when we analyze the budget estimates further, so just write them down, otherwise you'll get the PDF. But whatever I'm explaining you which is not there in the PDF, any conceptual clarity you require, just write them down simultaneously. simultaneously. So next time I'm not gonna repeat all these concepts, right? Because it will save our time. So gross tax revenue. What is gross tax revenue? Why is it not net? So gross, total tax revenue, whatever you have earned from the direct taxes, indirect taxes. Gross is, this is something which has accrued to you in form of tax receipts before estimating for state share or any tax refunds broadly. So you know what happens is that central government receives these tax receipts. Out of it, it has to pay to the states as well. Sometimes there are certain taxes which are to be refunded. So there is a concept of tax refund. Sometimes people, they pay extra than their tax liability, so that can be refunded, it can be claimed. So before deducting for all these things, whatever tax revenue the government has comes under the gross tax receipts or gross tax revenue. Is this concept clear to everyone? Now whenever it comes later on, just remember this. So all the direct, indirect tax revenue collected by the government before deducing for the state's share as well as for the tax refunds, whichever eligible candidates are there for that thing. Understood, right? So gross tax revenue mein you have taxes from all these sources. You have corporation tax or corporate profit tax, which is levied on the net income or profit of the corporations or companies, right? Then you have taxes on income, of course, income. So income tax is a direct tax, right? Corporation tax, again direct tax. What is the difference between direct and indirect tax? Quickly tell me. I have discussed this thing a lot many times with all of you. What is the difference between direct and indirect tax? So if I am saying income tax is a direct tax, but GST is not a direct tax, what makes the difference? What makes the difference? So basically direct tax are all those taxes, the burden of tax means who has to pay that, right? So burden of which cannot be shifted onto anyone else. Getting my point? Say income tax. So if 5% income tax is levied on your taxable income, you cannot shift it onto some other person. But in indirect taxes, say cost of production, you have paid some tax, on inputs you have paid some tax. So there are several stages on which the tax is paid, and then that is finally reflected in the market value of the final good. So effectively all these taxes have been shifted to the end consumer. This is how indirect tax is. So this is how we classify between direct tax and the indirect tax. In indirect tax, you can shift the burden to the end consumer. Is this clear to all of you? Right? So you have wealth tax, tax on wealth, then you have customs, tax on imports, then you have union excise duties, so certain excise duties. So excise duties are effectively the duties or taxes levied on the production of certain things, right? So excise duties on alcohol, petroleum products, any cess, surcharge, etc. What is the difference between cess and surcharge? Then you have service tax or GST. Now you have GST, right? GST, you all know, goods and services tax, is an indirect tax which has subsumed all other, almost all the erstwhile indirect taxes, right? And for GST, you have CGST, UTGST, IGST. That is something else. Now you tell me what is the difference between a cess and surcharge, because these terms are going to come every time in the budget, okay? So we will not repeat them, we will discuss them once. Cess is fixed, surcharge is variable. This is not the primary difference. This is not the primary difference. What is the primary difference between a cess and the surcharge? So surcharge basically is or surtax as we call it. We can also call it a surtax or surcharge. Surcharge or surtax is basically, tax on tax. It is calculated on the already levied tax. So for example, there are super rich people as well in the country, right? And you have lots of events going on. You are well intelligent enough to understand my hint, right? So you have super rich people. On those incomes, say income tax is levied. Tax on that tax. So it is calculated as tax on tax, okay? Surtax. Cess is basically for a particular purpose. Remember this thing. So say Swachh Bharat Abhiyan ke liye you have to raise funds. So imposing Swachh Bharat cess. Education ke liye you have to raise funds. So educational cess. So the fundamental difference is that cess is for a particular reason for a particular purpose, and surtax is say for redistribution objective, tax on tax for example, redistributing the wealth say from the richer ones to the poor. How do you redistribute it? Not redistributing like this, that okay, taking from the rich and distributing to the poor, no. Charging higher to the super rich people and then using that amount for the welfare schemes of the targeted groups. Have you understood this thing? So this is the broad difference, right? Now, moving ahead. So these were certain heads of your tax revenue. Now, if you see the non-tax revenue, you should be very clear about what comes under the non-tax revenue as well. Okay, you should be very clear on this. So you have interest receipts. Remember, these are only interest receipts. This is not repayment of loan. Remember this thing. This is only interest receipt, not repayment of loan. Why? Why am I saying that? Because if you have given loan to someone, loan classifies, जो भी देता है लोन उसके लिए lender, for a lender the loan is an asset, isn't it? For a lender, loan is an asset. For the borrower, it is a liability, right? So since you have given loan, and if the loan gets serviced, so essentially in your balance sheet the assets get reduced, yes or no? So this is just interest payment, not interest payment will be your non-tax receipt or revenue receipt under non-tax class head, not the loan repayment. Loan repayment reduces your assets, so it will be your capital receipt. Clear, everyone? You will remember this thing. Next, dividends and profits, as we have seen, any external grants which you have received, other non-tax revenue, and receipts from the union territories. So central government also earns from the union territories, say UTGST, GST levied on the intrastate sale of goods and services, intrastate, in between the union territory. All other proceeds whichever they earn from the union territories as well. Clear? Then this head, other non-tax revenue. So you have non-tax revenue list, then what are these things then classified under the other non-tax revenue head? So other non-tax revenue includes these things. Again, these are very important. So you have examples of other non-tax revenue. You should remember all these terminologies. So in other non-tax revenue, so you have a subcategory under non-tax revenue receipts. These are your other non-tax revenue receipts. What are these? Fiscal services. So these are certain services, you know, provided by the government. So for providing these, the government earns out of them. These are categorized under non-tax revenue, other non-tax revenue receipts. So you have fiscal services. What fiscal services? Fiscal services like currency, coinage and mint. So you know, government earns from minting process as well, minting of coins, like the assaying fees. So basically assessing the quality of the materials or the metal, and then you also, the government also earns from from the smaller coins, right? Smaller coins, small coins you have. All these earnings of the government of India from say minting process, currency, coinage, all these things, they come under the fiscal services provided by the government. They also earn from this thing. Is it clear to everyone? Then you have social services, economic services, grants in aid, etc. In social services, these many services provided by the government: education, medical, public health, family welfare, housing services, information and publicity. Then you have labor employment, social security benefits like your pension, PF, all these things, right? Social security benefit, old age, your pension funds, then your PF account, right? So social security and welfare, all these things, they come under the social services. Then you have your economic services. So whatever service government provides or renders through economic sectors like your agriculture and allied services, industry and minerals, then energy, transport, communication, all these sectors of the economy broadly, they come under the other non-tax revenue receipts category. other non-tax revenue receipts category. I hope this much is clear to everyone. Any doubt so far? Is it clear? Now moving ahead, I hope there are no doubts regarding this. So we have seen revenue receipts, right? We have seen revenue receipts. Now you can classify. Also remember the differences I told you, that loan repayment is not there, only interest payment is there, because interest payment is not affecting your asset and liability status. Remember this thing, okay? Now comes revenue expenditure. So in revenue budget we have seen revenue receipts. Now whatever government spends, expenditure, which expenditure will be categorized under revenue expenditure for Government of India? So whatever expenditure is there which neither create any asset nor reduces any liability. Again, asset liability condition. Neither create any asset. Asset can be physical or financial. Any spending by the government, any expenditure by the government which is neither creating any asset nor reducing any liability of the government will be termed as revenue expenditure. So you know, like paying salaries, right? So government has to pay these salaries, say to the government employees. Now you pay the salary, it does not create any asset for you. It does not create any asset for you, neither create any asset, nor it reduces any liabilities which are outstanding on you, for example, right? So expenditure done by the government, but then it neither created any asset nor reduces any liability. I hope this is clear to everyone. So revenue expenses, say related to expenses incurred on the normal functioning of the government. You require day-to-day expenses to run your departments, to run your ministries, to run your government basically. All those expenses plus expenses required to run the departments, various services, establishment of defense services. So government provides these services, right? So you establish these departments, say defense, then interest payments on debt incurred by the central government. Now again, since interest received by the government was under revenue receipts, because it does not change asset liability condition, whatever interest payment on debt which central government has incurred, is under revenue expenditure. This is not repayment of loan. Remember, this is not repayment of loan. This is only interest payment on debt incurred by the central government and grants given to the state governments and local bodies and subsidies. Have you understood this thing, everyone? So interest payment done by the government, again not loan repayment. As I have told you, interest, only paying the interest, because it is not changing your asset liability condition as the definition says. Whatever in the loan is outstanding on the Government of India, you pay the interest for it. That is an expenditure, neither creating any asset nor reducing your liability. Liability will be reduced when you repay your outstanding amount of loan. Is it clear to everyone, right? Also remember this thing, because it is going to come in the deficit section as well. I'll ask you then. So focus on this line which says grants given to state government, local bodies and subsidies. So whatever subsidies you give, whatever grants you give, grants, it is not loan, remember. So I am highlighting the differences again and again so that you pick up these differences. You should remember them. Loans, not loans, grants given by the central government to the state government, say, to the local bodies, any grants given to the local bodies or subsidies given to someone. All these will be expenses on side of the Government of India, but since they are neither creating any asset nor reducing any liability, they will be called as revenue expenditure. Also, the interest payment only is there, not the repayment of entire loan. Why it is not there, I have told you. Yes, grant is not to be repaid, of course, right? So I hope you will Remember the difference. So in revenue budget, you only have interest payments, whether the government is receiving it in the form of receipts or the government is incurring an expenditure in the form of revenue expenditure. Remember this thing, right? Is this clear to everyone till revenue expenditure? So we are done with the revenue account of the budget. We have seen the revenue receipts as well as the revenue expenditure. Now moving on to the capital account of the budget or capital budget, right? Capital budget. You will have economic survey series as well. Don't worry about that, okay? So let's first cover the budget. We have financial stability report to cover yet, right? So let's move on to the capital budget, capital receipts. What are capital receipts and then what are capital expenditure? So one thing you should remember, it is easy to differentiate. In your revenue account, it was not changing your asset and liability condition, isn't it? Be it receipts, be it expenditure in revenue budget. But in capital budget, it will do so. In capital budget, your condition of either asset or liability is going to change in both your capital expenditure as well as capital receipts. Are you getting my point? So capital receipts are all those incomes or receipts of the government of India for which either creates a liability or reduces any asset. Which either creates a liability or reduces the assets of the government. So basically it says you are earning, but you are earning against reduction of any asset or you have created a liability for that. So say आपने loan लिया, okay, you have borrowed from somewhere. Since you have borrowed it, so it is the receipt for you, but it is a liability. So you have created a liability for yourself. You have to repay that loan plus interest. So in that case, that receipt would be classified. So your borrowings will be classified as capital receipts. Is this clear to everyone? So capital receipts are receipts which either create liability or reduces the asset of the government. Say disinvestment done by the government. Say government sells out certain stake, its stake or share in a public sector undertaking, okay, sells out it to the private entity. Say 5% से government ने sell किया. Now this 5%, for this 5% stake, the government has earned something out of it. Government has received receipts, but it has lost the stake. So that stake was an asset for the government, right? So it has lost an asset. So it has reduced the asset of the government. So this is how we define it. Either create liability, say borrowing, or reduces assets, say disinvestment. You have received the receipts, but these activities are going on against those receipts. Is this clear? Okay. Now, so the main items of capital receipts, what will be the capital receipts? Loan raised by the government from the public, from wherever you raise the loan, from the public, say market borrowing, borrowing by the government from RBI, commercial banks, financial institutions, right? Borrowing from the foreign government, international organizations, whatever loan you have received from anywhere, whatever borrowing you have done from anywhere. So you have done the borrowings. Since you have borrowed, you have created a liability for yourself. So as per the definition, any receipt which creates a liability is a capital receipt from wherever you borrow, right? So this thing. And recovery of loans previously granted by central government. Now this is something important. I want all of you to focus here. Recovery of loan previously granted by the central government. Recently only I have discussed with you yes, revenue receipt it will be, okay, because it has not changed any asset liability condition for the government. The dividend from RBI, okay. Now see, recovery of loan. So whatever you borrow is clear to everyone, will be a capital receipt. But say central government has provided loan to someone and then it has recovered that loan. So this loan recovery will be a revenue receipt or a capital receipt. It is a capital receipt. That's why I said in revenue account, you only have either interest paid back by someone or interest which you have paid back on any outstanding debt. Remember that? Everyone, I'm asking all of you. Will you please, I would appreciate if you all respond to this, okay? So you remember the difference? Now, these are recovery of loans. Why recovery of loans? Yes, because it has reduced the asset of the government, because earlier you see the balance sheet, so loan will be classified as an asset from the lender's side, isn't it? So that's why recovery of loans previously granted by the central government will be a receipt, but then a capital receipt, because it reduces the asset of the government, right? I hope this much is clear to you. Also, so any kind of borrowing as well as recovery of loan. Remember this term, recovery of loan. These are certain. So I have told you clearly what comes under which section. Should not get confused in further discussions, right? Okay. So now apart from this, if you see, it also includes small saving schemes, post office saving accounts, national saving accounts. So borrowings ho gaya ek side, then you have receipts from small saving schemes. What are these small saving schemes? So these schemes, you know, are intended to encourage the people to save. So they provide you good interest rates on the deposit. So whenever you invest in these, so these can also be termed as saving investment schemes, right? So basically, it can be viewed as a saving or as an investment because you earn interest on it. So small saving schemes, you have a lot of instruments for that, like your post office saving accounts. Then you have national saving certificates, NSCs, national saving certificates, provident funds, net receipts obtained from the sale of shares in PSU. So disinvestment is also a capital receipt. Understood? So whatever, why? Tell me why the money which accrues to the central government on saving schemes is a capital receipt and not a revenue receipt. Why? Because this is a liability for the government, isn't it? You have to pay back that amount. You have to pay interest on this amount as well. That's why these are capital receipts. So creating liability, right? Under revenue receipts, you don't have any liabilities. Is this clear? Right? So that's why all these money invested or saved under these small saving schemes, they will be a capital receipt because this is liability on the side of government. They have to pay back to you, right? Whatever you have saved under these heads. Plus disinvestment, say sale of share in PSU. I have explained you. So I have explained you, if government sells out a particular percentage of share, say in any PSU, receives the receipts, but then lost that asset, lost that ownership. So reduction of assets. Again, disinvestment proceeds will be capital receipts for that reason. Okay. लाइन ऑफ क्रेडिट से जो पैसा आएगा वो भी कैपिटल रिसीट्स के अंडर. हाँ, इफ गवर्नमेंट हैज रिसीव्ड एनी लाइन ऑफ क्रेडिट, okay, government has received any line of credit provided by any organization or government, will be a capital receipt. Okay, gold deposit scheme, of course. All these saving schemes, you know, all these schemes in whichever scheme the government is paying you, is obliged to pay you back, will be a capital receipt. Understood? Clear to everyone? Because then it creates a liability on the side of the government, right? On revenue receipt, you don't have any liability created against those receipts. Simple. All right, I hope I have answered all your questions. So let's move ahead further. These are the further heads. Next, these are debt receipts and non-debt receipts. So broadly, if you see, we can classify the capital receipts into debt receipts and non-debt receipts. Debt receipts, whatever receipts you have received on, say, any debt instrument or via any debt raising instrument. right? Say market borrowing, you have issued government securities. Via government securities, you have raised the loan. So government securities. Short-term borrowings, say T-bills. You know what are T-bills, right? Treasury bills. So government securities, treasury bills. These are managed by your Reserve Bank of India on behalf of the government, right? And the trading of these is done on the eKuber portal. You remember all these things? So T-bills. T-bills are short-term. Why they are short-term? These are short-term borrowings because they are issued for less than 1 year, say 91 days, 182 days and then 364 days. So your T-bills are issued for 91 days, 182 days and 364 days, right? Then you have securities again, so small savings are again debt securities. People have deposited their money for a fixed period of time, right? Then you have provident funds, state provident funds. State provident funds are what? State provident funds are also saving schemes by state government, for generally for state government employees. So again, saving schemes. Whatever you have received from a saving scheme will be a capital receipt. Clear to everyone? You see, gold bonds. So whatever bond scheme which the government is liable to pay the amount on will be your capital receipts. Gold monetization scheme. Again, so your question is answered here again, right? Okay. These are the things. State provident funds are also saving schemes by the state governments. I hope this is clear to all of you. Next category you have is non-debt receipts. Non-debt receipts. Receipts which are capital receipts, but they are not in a form of debt, not in nature of debt. So your recoveries of loans and advances, remember this thing. Recovery of loan and advances, whatever loan say you have given to someone has been recovered by you, right? Has reduced your asset, that's why it is again a capital receipt, as we have discussed. Disinvestment receipts, as we have discussed number of times. Okay, so this is your capital receipt section. Then you have capital expenditure. Capital expenditure. So again, all those expenses of the government which are either creating any asset or reducing the liability of the government. So again, asset liability condition checked, right? So any expense of the government which is either creating asset or reducing the liability, capital expenditure. All those expenses of the government which either create asset or reduces liabilities are called capital expenditure. Is this clear? Capital expenditure, right? Now you see, whenever budget is to be presented, yes, deposit is a liability. Whenever budget is to be presented, we all look for capex. In short, we call it capex, right? Capital expenditure. So in capital expenditure, because capital expenditure creates assets, so whenever government increases its outlay on capital expenditure, everyone welcomes it. Are you getting my point? Because when your expenditure on something is creating capital assets which are further going to make you earn for the economy, is a good expenditure, is a good spending. It has generated those kind of assets which will help you earn in future, right? So capital expenditure either create asset or reduces liability. So it will include, say, acquisition of any land. So you have created an asset, okay? Then building, machinery, equipment, capital outlay, say for defense services, you have added to your defense equipments, for example. So they are also your assets, right? So you have created assets. Yes, it has a multiplier effect. Purchase of shares by the government, loans and advances by the central government to state. Now purchase of shares. So purchase of shares is a capital expenditure. Why? Because it has given you ownership. It has created asset for you, isn't it? Then loans and advances by central government to state or union territory. Loans and advances by central government to state or union territory. Yes, because you have given loan to say any state government or any union territory, so you have created any asset, right? Because you have given loan to them, for them it will be a liability, not for you. Understood? So this is how all these expenses will be classified under your capital expenditure. Is this clear? What is capital expenditure? Either create asset or reduces liability. Yes, FSR is going to be there. We will complete FSR as soon as possible. Okay. Nothing is going to be left uncompleted. So, okay. So nothing is going to be left incomplete basically. I will complete all the remaining parts of the FSR as well. We will do everything. Like we have covered the RBI annual report fully, we will cover the FSR as well, we will cover this thing as well. Whatever I have started, I'll complete it, okay? Rest assured from at least for this thing. Do not worry about that. So these were your revenue and capital budget. I hope the classifications are clear to all of you, how we differentiate it, how we define them, what all falls under. So you remember the difference between interest, all the interest payment and receipts will be in the revenue account, but loan recovery and all will be there in the capital account. I have told you every detail, right? So I hope you will remember these these distinctions. You will distinguish between them. Now there are certain deficits which are of very much importance. Whenever you have these budget, you have the estimates of the deficit as well. Okay, you have the estimates of the deficits as well. So what are these deficits? Now quickly try to understand, when is there a deficit? When do we say there is a deficit? Whenever you fall short of income over your expenditure. Simple. So if you are say earning 60,000 per month, but your expense is 70,000, so 10,000 is your deficit. Clear? Okay, budget deficit or say fiscal deficit overall. So these deficits are there for the government as well. Now why they are there? Because government has a lot of responsibilities to deliver, you know, and it has a lot of sources for receipts as well. Yes, we have seen all the receipts, but then government cannot cut down on its certain liabilities. It has to do welfare of the public. So primary objective of the government is the welfare of the public or public welfare, right? That's why government incurs these losses. Although we need to have a check on these losses as well. Why do we need to have a check? Because any deficit which is crossing its limits or whatever is given under the FRBM Act as a desirable limit is harmful for the economy in the longer run. It can impact even your trade relations. It can even impact your BOP. Right. So you have these government deficits when your expenditure is more than your receipts basically. So in deficits, you have different categories or different deficits. You have revenue deficit, fiscal deficit, primary deficit, and then you have effective revenue deficit. So first in front of you is revenue deficit. Clearly, as the name suggests, what is revenue deficit? Revenue deficit is, it is just a part of the total deficit. So here you will not have any component of capital receipt or expenditure. It will be a deficit on account of capital expenditure exceeding the capital receipts. Is this clear to everyone, right? So revenue deficit will be difference between the government's revenue expenditure and revenue receipts. Revenue expenditure minus revenue receipts. This is not total expenditure minus total receipts. That would be fiscal deficit. So here we are excluding the capital budget. Here it is only the excess of revenue expenditure over revenue receipts. Have you understood that? Now this is harmful. Revenue deficit is more harmful than fiscal deficit. Let me tell you why. We will discuss that. So you should try and understand the implications of deficits as well. Why the opposition is always crying that the government is not limiting these deficits. Why do we want to have a limit on these deficits? Yes. So when we say that revenue deficit is revenue expenditure minus revenue receipts, it means what? You have excess of revenue expenditure over revenue receipts. What is revenue expenditure? For which no asset is being created. You are just paying out, say, salaries. You are just managing your day-to-day operations of ministries, departments and all. So you are not creating any asset. So if such expenditure exceeds your revenue receipts, that excess of expenditure will again be financed by borrowing. That borrowing, which is that amount which is borrowed to finance, say, revenue expenditure, is something going totally into pure consumer kind of spending. You are not creating any asset against it. It means you have borrowed, you have created a liability for yourself, but out of that borrowing you have not created any asset. You are you're utilizing that entire borrowed amount to finance your revenue deficit, to meet your day-to-day expenses. So this is a new concept here which you should remember. Whenever you borrow, if you are borrowing for your own consumption, will be harmful for you. Okay, whenever you borrow for investment, it is good. Why? Because when you invest, you create an asset. That asset can make you earn. Out of that earning, you have a probability of servicing that loan, paying back that loan. But if you borrow for consumption, you have consumed it, nothing left. From where will you repay that loan? Are you getting my point? So revenue deficit is actually more harmful than fiscal deficit. Is this clear? So that's why we say revenue deficit is bad, because that shows that government is borrowing to do revenue expenditure or to finance its revenue deficit, which is neither creating any asset nor reducing the liability. Is it clear to everyone? Right? So that is the reason. Right? Because the majority part of the revenue expenditure is, say, paying salary, pension and interest payment, subsidies. These are not creating any assets for the government. Simple. That's why we say that revenue deficit is bad. Remember this thing. Revenue deficit is bad. It is not good for your fiscal or economic health. It is not good. Right? Because it would mean lower future growth and adverse welfare implications. If you borrow more and more to finance your revenue deficits, your borrowings will increase, but then your probability of paying back that loan would have a question mark. Also, then whatever you earn will be used to finance such deficits which are not creating any assets. So I hope you have understood what is revenue deficit, why is it harmful, what are the implications of revenue deficit if it increases. Right? So this is the thing. Also, then you have something called as FRBM Act. FRBM Act of 2003 and 4. So Fiscal Responsibility and Budget Management Act. This act basically gives you criteria. It sets out targets, objectives that your fiscal deficit. So say for example, under the FRBM Act, the target under the FRBM Act, the target of fiscal deficit was to keep it at 3% of your GDP. At 3% of your GDP, right? The fiscal deficit. So it sets out all these targets. Why does it set out all these targets? Because you need to curtail these deficits. Because whenever the deficit is there, the government finances it broadly through borrowing. And if you are borrowing a lot of money, that leads to crowding out effect as well. Yes or no? Do you guys catch up with me on this thing, crowding out effect? We have discussed this thing earlier as well. So that government, when borrows more from the market, it leaves less of funds available for the private investors and borrowers. So basically the fund availability or the loanable funds, they get reduced in the market, and then you have the crowding out effect. Yes or no? Yes, right? So these things are there. Also, we will discuss in future classes the effective revenue deficit. So revenue deficit, you by now you know that it is bad for economy. More bad than this is effective revenue deficit. What is the concept of effective revenue deficit? I'll tell you in the next class. Okay. So for effective revenue deficit, it is to be, the target is to be 0%. The FRBM Act sets a target of 0% of your GDP. If there should be no effective revenue deficit. if you want to be on a path of fiscal consolidation. Are you getting my point, right? So these are the things we will see. This 3% target was for fiscal deficit. These are again revised. So this FRBM Act also has revisions. So these targets, they have been revised under the chairmanship of NK Singh committee. So we keep on revising these estimates, but the essence is how much should be the cap? Why are we trying to cap these deficits? I hope you have understood the reason behind this. So this was your revenue deficit, revenue expenditure minus revenue receipts. Then you have fiscal deficit, which has overall total expenditure minus total receipts. So when you have total expenditure of the government exceeding total receipts, so total means it has both revenue as well as capital expenditure and revenue as well as capital receipts. Now it excludes borrowings. It excludes your borrowings, right? So this is the formula for fiscal deficit. Fiscal deficit is the difference between government's total expenditure and total receipts. Here we will have both the capital and revenue expenditure and capital and revenue receipts. So this is the formula. So excess of total expenditure on total receipts is your fiscal deficit. This is also known as budgetary deficit. This is an important indicator of government's fiscal consolidation situation, government's finances. That's why we all track the fiscal deficit figures, right? But it excludes the borrowings, capital receipts excluding the borrowings. You know, whatever government receives from the capital receipts, we have recently seen is a from the borrowings is a capital receipt, right? Whatever government borrows from any source, say domestic or international or RBI or market or bank, whatever the source of borrowing is, borrowing comes under the capital receipt head for the government. So we are excluding the borrowings in the capital receipts while calculating the fiscal deficit. This is to be remembered. So effectively the formula comes out to be total expenditure minus total receipts apart from the borrowings or other than borrowings. Why is this excluded? There's a reason. So basically the calculation says that because whatever the deficit is actually equal to the borrowing. Government borrows for what purpose? To meet this deficit. So if you include it, the value of expenditure minus receipts will always be 0. I'll tell you with a numerical. Why do we exclude this thing? Yes. So I'll tell you with an example why do we exclude this. So I hope broadly what is fiscal deficit is clear to all of you, right? I think I'll end this session here. So it is not good to make this session too longer. Whatever is left, we will try to cover in further parts. Also, rest assured, I am trying to cover all these classes as fast as possible, also not compromising upon the fundamentals or the quality of the classes, right? So, from here, from fiscal deficit, I'll explain you why borrowings are excluded and what are the implications of fiscal deficit. Then we will have the primary deficit and effective revenue deficit, okay? Then it will be done. The static portion will be done. After that, in tomorrow's class only, we will be starting with the budget at a glance section. Whatever estimates are being provided, they are provided in this budget, okay? So then you will understand all these terminologies now, that this much is revenue receipt, this much is gross tax receipts, collection of the government, all these things, right? Is there RBI FSR session? Not today. We will have it maybe tomorrow or day after tomorrow. We will have those remaining classes as well very soon, as soon as possible, right? So only this much is left, primary deficit and effective revenue deficit. Then we are done with the structural part of the budget. Then we'll continue with the budget at a glance or the figures provided in this union budget, right? We will highlight all the important figures. You try to remember them. Also try to revise these concepts. So prepare simultaneously for, say, phase 1, phase 2 interview, all these stages. You will get the PDF, right? So I hope this much is clear to you. I have stopped on the fiscal deficit topic. We will resume from that topic tomorrow because I don't want to extend this class further. All right, thank you so much. Stay tuned in all these classes of reports and budgets and all these. are meant for you only, right? Thank you so much for staying tuned, staying focused and interactive. Have a good day. I'll see you in the next class. Thank you so much. Have a good day.